Hello, everybody. Thanks so much for joining for this live webinar on a deep dive and update of our fund, the Aspen Private Credit Fund. I am going to go through pretty quickly the fund, the strategy, really, why we see there as a big opportunity here. And then we're going to spend most of the time talking about the deals we've closed recently in Q2. Go into kind of deep dive of the assets that we've recently closed on, a look at our pipeline going forward, and really why we're very excited about the momentum we already have in this fund and continue to see going into the second half of 2024. So without further ado, we're going to get started, and I'm going to make this a pretty quick webinar. I've recorded some longer webinars that you could review later on if you're interested. This will be about a 25-minute or so presentation. I'm going to run through some of these things fairly quickly, and then I'll leave some time for Q&A at the end. So if you have questions, we can address those live. So appreciate you joining here, and let's get going. So you can see here, this is the Aspen Private Credit Fund. We're calling this an opportunistic income-focused fund. Again, real quick before we get in, got to give the disclaimer. This is not an offer to sell securities. You need to review the full private placement memorandum to review all the risk factors and projections and the full details in that. This is, we'll make some forward-looking statements and projections. Those are not guaranteed, and any past performance is not necessarily indicative of future performance. Okay, with that. All right, so if you're new to Aspen Funds, not super familiar with us, I'm going to give a real quick background of our principles so you get to know us a little bit. For those that are familiar and have been around, I'll make this quick. But Aspen Funds was started over 11 years ago by our two co-founders, Bob and Jim, both from unique backgrounds. Bob was actually a tech entrepreneur and became really an investor and finance expert in the second half of his career. Jim has been in real estate investing for over 30 plus years. And they really found a unique opportunity that started and launched Aspen Funds about 11 plus years ago, buying up distressed mortgages coming out of the great financial crisis. Well, fast forward now, we continue to operate those funds, and it's really created a big launch pad for us to really dial in where our expertises are, where we find the best opportunities in the market, where we have the best resources as a team to execute on what we believe or we call macro-driven alternative investments. And so I'm going to get into that in a minute. The other kind of parts of our principal or management team are Dan Schulte and myself. So Dan, he is a former general counsel of a large money manager here in Kansas City. He left that in 2014. Has been in private equity investing for a long time. And then myself, my background is in commercial banking, was in a lender, an underwriter for many years before joining Aspen Funds. Right now, I'm responsible for the capital formation, investor reporting, all the asset management, as well as acquisitions. Okay, with that, a little bit about how we find deals. So our process for identifying deals is different than some. We call it a top-down approach where we're looking at what we believe are key macro trends that are in play and likely to continue. We want to identify where we see the biggest opportunities in the market, and then we want to position and create funds, opportunities, structures that are going to benefit from those trends. And we put together the best-in-class teams, investment funding structures to execute on those. So we would start with the kind of big picture first, see the opportunity, and then create the right structures and business plans around that. This fund is no different. We spent a long time putting this together and building the structure that you will now see and opportunity set. So a little on our track record, we've been operating for over 11 years. We've managed over $200 million of investor capital, over $500 million in assets, and like I said, 11-year track record, over $50 million of investor distributions since inception. It's my favorite number. We're sending money back to investors. We have experience across a lot of asset classes. So we've, like I said, started in mortgage notes. but have expanded into a lot of other asset classes in commercial real estate as well as non-real estate like oil and gas, and continue to build that footprint. And lastly, we have a podcast. If you are like podcasts, if you haven't listened to our podcast, definitely encourage you to dive in and check out some of the content we create there. Okay, so let's dive right into the fund. So that's going to be a quick kind of synopsis, but this is the Aspen Private Credit Fund. This is an open-ended fund, which is different than some funds you may be familiar with, but something we've been doing for over 10 years. We've been running open-ended funds for over a decade. And the goal of this fund is to provide credit to commercial real estate properties through a variety of different structures, whether that's preferred equity, mezzanine debt, bridge loans. There's really a big dislocation in the capital markets right now where banks have pulled back significantly. It's harder to raise equity, but values have come down. It's a good time for operators to come into the market, take advantage of discounted pricing on these assets and really the long-term fundamentals that support multifamily specifically, but several other commercial real estate asset classes. So we're doing that as a very flexible capital structure, kind of structured finance with those different mechanisms. The goal of the fund is to provide current cash yield to investors. So we pay monthly distributions and then upside through profit share as the fund continues to add investments to its portfolio. So some of the key reasons to invest: high current yield. It's difficult to find strong yielding products in the real estate backed right now. So our goal is to be paying out consistent monthly cash flow, plus you get the additional upside every quarter based on the profits of the fund. The fund will be investing in preferred positions of the capital stack. So we will be always in priority to common equity. So our capital will always have priority over normal equity investors. If you've been investing in syndications or funds that are not credit focused, which a lot of people have, you will be investing generally in common equity, and this fund would have priority over those investments. And so when we're coming in, we always have some form of priority. A lot of times we have certain control rights that can spring into action based on different things that happen in the project, which I'll get into. It's an open-ended structure. So the goal is to operate an open-ended fund. We're going to always be raising capital and always be deploying deals. We've been doing this for a long time. We're going to set a quarterly net asset value that investors can come into the fund and redeem from the fund at. You'll receive quarterly statements. If you've been following us for any length of time, we have a strong track record. We've been operating these types of funds for over 11 years. Alignment, co-investment. We're investing as principals alongside all of our investors. We invest in every fund, every deal that we put out for just true alignment and co-investment. And this is going to be a diversified portfolio. So we've already got 4 assets that I'm going to talk about in the fund. We got a lot more slated for Q3 and Q4, and it's going to continue to grow as the fund grows. So it's great momentum, great time to be looking at this fund. So the way that this works is an open-ended fund, a little bit different, right? We start paying preferred returns monthly with quarterly profit share every quarter for upside, as cash flow is available after 3 months. We have a 3-month kind of initial delay, and then you start accruing and earning those returns right away. We have the ability to compound, so you can automatically compound and reinvest those earnings back into the fund to buy more shares to compound your return. And the idea is it's open-ended fund, so we're calculating a net asset value quarterly that you can come into the fund, you can add to your position. The fund will continue to invest in preferred equity, mezzanine loans, and commercial real estate. It's non-dilutive, so all the new capital is going into income-producing assets. And we have liquidity. So one of the benefits of credit-focused funds is liquidity when it's structured correctly. So we have a 2-year lockup and then a 90-day notice for best efforts liquidity. For large positions, it may take a little bit longer, but we do have that liquidity option. So if you need your cash back at a certain point, after that 2 years, you have the ability to redeem your position. Real quick, we have some different share classes, different minimum investments. So Class A, $100,000 minimum, Class B, $1 million minimum, Class C, $5 million minimum. And you can see the differences there But the number I want to kind of point out here is the total net return. So we're targeting low double-digit total returns for Class A between 10 and 12%. If you decide to receive the distributions, that 10 to 12% will be made up. A large portion of that will be paid in cash on a monthly basis, and then the additional return will be added to your capital account that can be redeemed, once your position is redeemed. If you decide to compound your return, you can basically reinvest all those earnings back into the fund to earn a higher return. That's a compounded return for the Class A, 11 to 14%. So you can get a little bit higher yield if you compound your return. Okay, I'm gonna spend just a few minutes. I did a whole master class on private credit, what's driving interest in this sector, why is there opportunity. So I'm gonna not spend a whole lot of time on this. I have a few select slides I've chosen. You can watch the full master class. I believe it's nearly an hour or so to understand more of the trends going on if you'd like. But with that, the big story here is there's tighter credit in the marketplace. There's a dislocation of available capital, especially kind of the lower middle market of real estate, commercial real estate, and that's creating pretty big gaps. So you can see here, this was a survey done with a lender survey of how are things impacting their expectation for the market in commercial real estate. And so you can see there's a lot of negative impacts that are shown here on this chart, and that's impacting the bank's willingness to lend on new deals. And so they're pulling back on the leverage ratios, or they're not doing deals at all. So it's difficult to find financing, which is creating a big gap and really an opportunity for non-bank lenders like us. The other big challenge that banks have is a lack of payoffs. So if you've been following what's been going on in the commercial real estate market for any, the past 12 months or so, there's a huge amount of maturities that have hit end of last year and this year and next year. And a lot of those loans will not qualify for refinance right now because of higher interest rates and just the overall market being slightly down. What that's causing the banks to have to do is to extend the loan. So they have to extend their loans, which is creating a lack of payoffs. So basically, the banks normally use the liquidity from the payoffs of those loans to then lend out to new properties for new loans. And that's not happening as much as it was because of this kind of buildup of assets on the balance sheet that cannot get paid off on. Additionally, banks are more structurally restricting lending as the new Basel III Accord regulations are coming and pushing more regulation on banks. It's increasing the capital requirements, increasing liquidity requirements, increasing compliance costs, et cetera. And what that's doing is actually create a huge consolidation in the banking world to where a lot of the smaller banks are being gobbled up by big banks. And the reason that that's not great for the kind of small middle market is big banks generally want to make bigger loans. They're much more risk averse. They're not community focused. They're not looking at the particular dynamics of that market. And so it creates, again, a bigger gap for some of these other deals that are needing the capital. But at the same time, we're seeing long-term fundamentals that are strong, especially in housing, which is one of the primary focuses of this fund. In multifamily, there's been a chronic underinvestment in housing by most estimates you can find online. And it's been a big issue for a long time. And so we've seen a big supply surge. There's been a lot of deliveries of new apartments in the recent time periods. But the new starts that are, the new construction is being started, and the deliveries that are expected over the next 18 to 24 months is significantly lower than what we already need. There's been a big drop-off in new construction. And so we believe that there's going to be a really big rebound, a really big demand come back for multifamily over the next few years, even though there is strong demand right now. We're already seeing it, but I think it's going to become even more acute to what we saw even a couple of years ago. There's a shrinking single-family buyer pool. As mortgage rates have gone up a lot, it's priced a lot of people out of the market. It's driven more need for housing. Renting is much cheaper than owning. Household formation is strong. These are all drivers for rental markets. And really what's interesting is across the board, even though some markets have had challenges with rents, the really high supply markets, the bottom quartile, like some of the markets in Florida, Austin, Boise, Atlanta, et cetera, these markets have had a lot of new deliveries, and so it's pushed down rent growth because there's a lot more product competing for the tenants. But the top quartile markets, the more Midwest markets, the Rust Belt, even the Northeast, in 2024, there's actually expected rent growth. In Kansas City, there's actually, where I'm at here, is an 8% rent growth expected for 2024. So pretty substantial. So it's very mixed, right? Depending where you are in the country and what dynamics are going on. So those are some of the things that driving the opportunity set here that really think creates a perfect time for a very flexible fund like ours to come into the market, provide very flexible financing on really good deals and good sponsors. So where we're investing, you can see here on the chart, we're investing lower in the capital stack in the preferred equity or mezzanine debt section. So you can see it's above the senior debt. So we're paid after the senior lender, but we're paid before the common equity. And so it gives us a lot of comfort, capital protection, because we're generally sitting behind a good amount of common equity. We have priority of payment before the common equity. We get current cash flow, as we're similar to a lender that we get a current pay portion of our interest or our return is being paid every month from the borrower to us. And we're lower in the capital stack, reduces risk of capital loss. So we can go invest in these projects at a lower basis than the equity investors, right? Because our last dollar in is only a portion of the total project cost or the value of the property. And so we have a lot of capital cushion protecting our position. In a lot of these deals, we can actually take over a deal or force a sale if not meeting expectations. So we have springing control rights, which I'll explain some of those in a minute when we get into the actual deals themselves. Why private credit? If you can see here, this was done by BlackRock that just recently, they ranked all these different asset classes based on risk and return over the next 5 years, and lending, direct lending, which this would classify into, is the number one asset class expected to, from a risk-adjusted return standpoint over the next 5 years. We're seeing the exact same thing. So this is what we believe is a huge opportunity. How do we source deals? So we have a lot of brokers that are in our network that we've been working with for a long period of time because we own a lot of real estate. We've been investing in real estate. And so they have deals that need capital, and they know us, and they can make introductions. So we're seeing a lot of deal flow from a really extensive broker network. Lenders, we also have great relationships with a lot of lenders. They come to us and say, hey, the borrower needs a little more capital, or we can't get our leverage ratio up right now. Can you guys come in and fill out the capital stack? And we also have sponsors reach out directly to us. So we have a pretty big sponsor network that we've built out over the years. It's where we get deal flow directly from the sponsors themselves. So let's look at some examples of different types of deals that we're going to do. And I'm going to get into some of the actual deals themselves. So most of what we've done are new acquisitions. So these are new deals. This is not what some people call like a distressed fund, a distressed asset fund. We're not generally going to be investing in deals where there is structural distress, because those are, a very different type of underwriting, different return profile, and different risk profile. So most of our deals that we'll be doing are new acquisitions. And there are a lot of recapitalizations that we can do. Things I'll get to that in a sec. But some of the needs are a quick close or gap funding. So a senior lender falls through, they can't raise the equity in time. The goal here is to bridge the gap. It's a short-term loan generally to help them close the deal and then get paid off, replenished through the equity or from another lender once they have a little more time. So give a little some breathing room. Another common one we've seen is loan assumption. So this is where the new buyer is coming in to purchase a property and they can actually assume a low interest rate loan, which is great, right? We all want yesterday's interest rates if we can get them. And so that's a very common strategy we're seeing right now. The challenge with that is generally when these loans were originated, they've been amortizing down or they originated at different values. So the LTVs are usually pretty low. So the goal here is to increase leverage. We can come in and actually be accretive or beneficial to their common equity and still be in a great position in the capital stack. Another area is new construction. So banks are reticent to lend. Right now, I've really pulled back on LTVs just because of that reticence. And so the goal, again, is to increase leverage and help the deals get completed and done. In existing deals, there are certain distressed situations that we may look at. It's pretty difficult to make a lot of these deals work, right? A lot of these deals were just purchased at a value that was just overpriced, and it's difficult to get to an NOI or an income that they actually need to get to refinance. And so, there are situations where it might make sense, but either they have an interest rate cap that's expiring, they need to purchase, they need to bolster up the reserves. The lender is saying, hey, we need you to bring in a little bit more equity to get this property to kind of bridge it to stabilization. There's different things that can happen. There will be certain situations that will make sense with a very clear kind of path to stabilization. And the goal, again, is to protect the equity. But in those situations, we're coming into an existing deal and we'll actually get priority over the common equity. So we're coming in to that deal as a way to help them keep the deal going. But we actually have priority over their common equity. Another one is capital injection. So this is an example where existing property already has good in place debt. So they have a low interest rate, or they got a good remaining term. They don't want to refinance yet, but they need additional capital to finish a renovation program, to finish some CapEx, to do some additional development. We've seen that. So there's a lot of situations where that makes sense, but they don't want to refinance or go get new debt. So we can come in behind that debt and help them complete that plan. So I'm going to get into now. We have 4 different deals that we've just recently closed on in Q2 of 2024. I'm going to run through these pretty quick just for time's sake. If you have questions, I did actually full video reviewing these assets in a more in-depth way if you'd like to review that. So this one is a loan assumption. Like I said, the sponsor is assuming an agency loan of a 2.94% interest rate. Like I said, yesterday's interest rates, these are great rates. And the challenge, though, for them is the senior leverage is low. It's 45%. So we're coming in, we're bringing up the overall leverage, and that actually helps their investor returns for the common equity. And we still sit in a really comfortable position. So we invested $1.5 million into this property. It's actually a property in my backyard, about 5 minutes from where I live, in a great submarket here in Kansas City called Lee Summit. And this is sitting behind Freddie Mac. So this is an agency lender, and we are preferred equity. They fully approve this. We have forced sale rights. So if the borrower does not pay our current portion of our interest, we have the ability to force them to sell the property. So it's kind of the ultimate detonate button if we need to. Obviously subject to the lender approval, but that does allow us some additional leverage in the situation that they're not performing to our expectations. Our combined LTV in this one is 60%. So our last dollar in is only 60% of the value of the property. So it's covered by about 40% equity cushion. What we're charging on this is a 2% origination fee. We're charging them 8% current annualized interest plus 6% accrued on the back end, compounded monthly, plus a 1% exit fee. So, from a risk-adjusted return standpoint, we believe this is really, really impressive, really incredible. Our term is 3 years. It's coterminous with the senior. So when they have to refinance the senior, they'll take us out. You see a picture of the property. You can see it's a nice Class B property in a great submarket. Vertically integrated sponsor team. So we spend most of our due diligence, obviously in the property, but mostly on the sponsors, and want to look at their track record, understand their portfolio, how they've done in the past, et cetera. And there's a significant amount of margin in that deal. Another one we really like, this is a Class A industrial building in Waycross, Georgia. This is a pretty awesome acquisition. Basically, this was a build-to-suit. Is a tenant-owned building. It's, like I said, a Class A recent build, nice 200,000 square foot industrial building. That tenant is now moving. So our sponsor has purchased this for a really incredible basis. They got it for $52 a square foot, which is about 30% below replacement cost. And so we're coming in, layering a little bit of pref equity, helps increase their investors' return, and gives them the ability to fully capitalize the deal to go execute this business plan. In this particular deal, we are preferred equity. We have takeover rights and for sale rights. So similar to the Freddie Mac loan assumption deal, we have the takeover rights where we can force them to sell. It's kind of the ultimate detonate button. But we also have additional rights that are called takeover rights, control remedies, to where if they are not meeting our expectations, our covenants, our current portion of our interest, we can basically fire them, remove them as managers, and take over the management of the decision-making of the property. Again, this is subject to the senior lender's approval, but this is agreed upon by the senior lender at closing, so they understand that we're in the mix and would step in if something is not going according to plan. Our combined LTV in this one is 75%. The rates here: 2% origination fee, 5% annualized current pay, 10.5% accrued, compounded annually, and a 2% exit fee. You can see some pictures here. One of the things that I love about this deal, talking about sponsor focus of our underwriting, these are what I would consider institutional level sponsorship group. Very impressive track record, very lengthy time in the market, really an exclusive focus on industrial. I've wanted to do a deal with these guys for a long time. This came through a great referral source that we've done some deals with, a very reputable broker, and just really excited about this particular asset. Okay, next one. This is another one I'm excited about. I like all these deals because obviously I underwrite them all and negotiate them, and part of the investment committee here. But this one is, I'll call multifamily takeover. So this is really interesting. So the prior owner of this building, not our borrower, not our sponsor, but the prior owner was forced to sell by the lender. So basically they were in pre-foreclosure due to underperformance. They were not executing the business plan properly. And so the lender, which was a bridge lender, one of the larger bridge lenders, they have basically reached out to this sponsor, who's now our sponsor, our operator, and has handpicked them and said, hey, we want you guys to purchase this property. We know we've worked with you in the past. You guys know what to do. You have other assets in this area. We'll sell this to you, and we'll actually lend you the new debt on that new purchase. They actually took a discount to their principal balance. They actually took a hit, a small write-off, and sold it to the new sponsor at effectively a 20-25% discount to what the prior owner had purchased it just a couple of years ago. And so because of that, they have a great basis. This sponsor is very, very impressive. They've executed this strategy, the exact same type of asset in the same area. There's another property just adjacent to this property. It's 100% leased with higher rents than their pro forma. So we believe a very conservative business plan, a great basis in the market. We invested $1.7 million as preferred equity with takeover and for sale rights. You can see the terms there. One of the impressive things in this sponsor, this is in the Atlanta MSA. It's right by the airport, great submarket, heavy workforce population, almost no new deliveries in the immediate area. This sponsor has over 20 full cycle exits. So very impressive. Most of their assets are in this area. One of the principals lives here. So very, very excited about this particular deal. Okay, and the last deal that I'm going to talk about is our multifamily development. So this is a deal that we did in Bentonville, Arkansas. This is a very experienced developer in Northwest Arkansas, which is one of the fastest growing cities in America. This developer has a very extensive track record, and this particular project is actually just a few blocks away from another asset that we own that's performing very well in this market. We really like this market. This developer, they've raised over $9 million of common equity for this first phase. We're coming in with $3.3 million. That sits in priority to that $9 million of equity. They're working with a local bank that we really like, have negotiated all these terms with. And, we feel like it's a really great project. I'll get into the underwriting here in a sec, but one of the cool things in this deal, so we actually have a lower, LTC than we normally do because it's a development, so the lender was very conservative in their leverage ratios. But we're coming in, we have a lot of equity protecting us. And, some of the kind of key pro forma or underwriting metrics we look at is the pro forma rents all based on current market rents, not what the rents are going to be a few years from now. Most of the construction starts have fallen off a cliff, like I talked about earlier, to where it's going to create a much tighter supply market when this is completed. There shouldn't be very much competition based on some of the deliveries. You can see here in the picture, it's in a great area. It's really an infill location. One of the last in kind of what's called Bentonville proper, which is where you really want to be in the area. It's right near Walmart headquarters, which they're building a multi-billion-dollar headquarters just a few miles away from this. It's going to attract a lot of jobs, a lot of tertiary employers to support that. And the exit valuation is, already been proven in the market. There's other recent comps that have sold that. So all the underwriting marks check off very, very well. And again, this is a very experienced developer in this market. They've been doing this for a very long time. We've reviewed their track record, the other assets, very impressive. And then lastly, so those are the deals we just closed in Q2. We got a very full pipeline for Q3, Q4, got a lot of momentum. Like I said, we've got a lot of capital already committed to the fund coming over the next quarter and are still raising more. So we have opportunity for investors to participate, basically come into the fund, the existing assets we've already done, and then participate in all the new assets that are going into the fund as well. So in my full presentation, I talk about kind of our target portfolio mix. A lot of the deals I showed you, or all of them, are preferred equity, but we also expect to have a portion of the fund in mezzanine loans as well as bridge loans. And so we have actually a lot of kind of secured lien deals right now, first lien, second lien, several multifamily and industrial, neighborhood retail, all asset classes we really like. We have over $20 million of deals in the pipeline right now. We're reviewing dozens and dozens and dozens of deals every single month to pick, the one, maybe two deals that we do in a month. And so we're very, very picky. We have a lot of deal flow and are kind of picking and choosing the very best deals from our network and that are being sent to us. So very excited about that. I got a full pipeline, like I said. I'm not going to spend much time here. This is the chart I was talking about, or kind of our target mix is going to be a balanced mix of preferred equity, mezzanine debt, bridge loans. Really, where we see the opportunity is in a check size in the $1 to $5 million per project. There's a huge gap just in general in the lower middle market, but most structured finance companies like ours will not go below $10 million. There's just not a whole lot of capital available. And so that's really where we can come in, provide a really great opportunity from just there's not a lot of capital competition for us. And then two, we can charge above market terms. You saw some of the terms on these deals. They're awesome for the kind of risk we're taking. And it also allows in a fund structure to create diversification, create a portfolio that investors get spread across a large range of deals. I'm not going to go into a lot of the advantages of our background and track record. You can see all that in the full presentation. But we've been doing credit-focused funds for a long time. We have very sophisticated underwriting, analytics. Our goal, like I said, is to be fast. So several of these deals we won because we were able to fund very quickly, do our underwriting very quickly, and all our due diligence. And we also have experience operating deals. So if we have to take back properties, we have a very extensive track record of operating, managing the real estate as the primary sponsor or owner. And so we're not, that's not the goal of this fund, but if we have to, we can do that. So we have a track record in credit. Here's all the kind of credit-focused funds we've launched. Here's a track record in real estate. You can review that all in our data room. And we have a strong support team. One of the things I haven't said yet, but it's very, very important for investors to understand is we are getting a third-party audit annually, so you can be able to see audit financials of the fund that will support the methodology and just the NAV calculations, and you can have confidence in the financial statements that are being prepared. We've used Polstonelli, which is a national law firm, to work on the offering documents, tax issues, and then McDowell Rice, which is a local firm, to help us structure a lot of these mezz loans, preferred equity, operating agreements, et cetera. So with that, next steps, if you're interested, like I said, we have a lot of availability right now. We have large commitments, but we also have a lot of good deals. So definitely have some room here. If you are interested, you can kind of take the next step to learn more, get more information. You can take a picture of this QR code. This will take you to schedule a call with someone on our team, or you can text the word credit to that number there, 913-214-1474. And that will get you to the next step to get more information, and we can get you what you need. We do the full data room, and you can review the asset deep dive in more detail. So with that, let's go to some Q&A. So I didn't quite hit the number I wanted to hit, 25 minutes, a little bit more, but I will kind of go to some Q&A here. And if you have questions, just put them in the Q&A section, and I'll answer them here live, and we'll go through those. So let's see. First question is, can you give an example return to investor? Yeah. So I showed that earlier. Let me see if I can pull it up quick enough here. So on this section, so we have, like I said, the total return. So that's a combination of the cash distributions you receive plus the increase in the net asset value of your shares of the fund, right? And so you kind of, every quarter will get a combination of here's the distributions you received, here's the increase in net asset value based on the profit of the fund that is being reinvested back into new deals. So a large portion, if you want to receive the distributions in cash, you don't want to compound, you would receive, we expect an 8 to 11% annualized return paid out in cash. And then the total return is expected to be higher than that based on the total cash you receive and distributions plus the increases in net asset value based on the profitability of the fund. If you want to compound, you basically take all the net income that are being per share that you get then reinvested back into the fund to purchase more shares, which then compounds your return. Okay, how returns tax? This will be a K1. So investors come into an LLC, become owners of the LLC. This fund will generate a K1 for our investors. So it's possible there may be passive losses when we are a preferred equity owner. We may get allocations of depreciation that we can then pass through to investors. So that's the reason we're choosing to do a K1, as there's the possibility of being able to push through passive losses for our investors. How many of your deals that went bad? If so, how? Default, if your investors lost any money. So no, yeah, we've not lost any investor money. We've been doing this, like I said, for a very long time. Our other funds, we have had defaults, right? That's just a part of, doing these types of deals. But the good thing is when you have the capital protection, you have a lot of things you can do to protect your position. So on a portfolio level basis, on a fund level basis, we actually generally make money in our other funds, our income fund specifically. I can't remember the number of defaults we've had or exits we've had. But on average, we've actually made money over our cost basis when we've had to issue foreclosure or take over an asset. And we expect the same in this scenario, which is why we're investing in that preferred position in the capital stack with control rights. Yeah, great question. How is this taxed? I already answered that. So historical default rates and recovery. Yep, we can get you all that information. If you reach out to our team, we can share all the historical numbers. How do you expect returns to change as market interest rates decline? Great question. So, one of the things we think there's a great opportunity right now, given the higher interest rates, and that's really creating a few things. One, it allows us to charge higher rates, but two, it really pulls back the availability of capital in the market, as I mentioned, because there's less payoffs available. So as those rates come down, there will likely be more availability than there is now, but there's still a structural dislocation of capital markets that we believe is going to continue and likely expand as these new Basel III Accord regulations that I mentioned, and just general consolidation of the banking industry as a whole. In private credit, preferred equity, these types of products have been around for a very long time. And so the rates of return that we're charging our borrowers maybe slightly higher, a couple percentage points higher than they were in the past decade or so, but not that much more. This is kind of the expected market rate of return for these types of investments. And especially in our segment of the market, kind of the lower middle market or the $1 to $5 million check size, there's not a whole lot of other competition that we're having to compete against. So we can charge above market returns, or rates, I should say, that are generally still accretive, which means still beneficial to their common equity. All in, we're going to be cheaper than their common equity. And so a lot of times we're not necessarily competing for capital from the lender, right? And that creates a bigger gap, a bigger opportunity set. But we're generally actually competing for equity, right? We're taking up a chunk of what would maybe be normally common equity, but we're cheaper than their common equity. So that's where the determination a lot of the sponsors need to make is, are they comfortable with our control provisions? But generally our rates, even at the rates I was showing you on these deals, we're actually going to be boosting the returns to their investors. So it's usually a good trade-off for them. Minimum investment amount is right here, $100,000. Percentage default from borrowers, it's historically very, very low. And our recovery rate is actually in excess of our cost basis. So on a whole, on a long-term average, we've never lost money in a default scenario. What is the AUM fee? Do the investors pay that fee? Yeah, so the AUM fee is assets under management fee. That's just a fee that is charged to the fund for finding the deals, managing the deals on an ongoing basis, negotiating the deals, et cetera. It's a very common fee in these types of funds. All the returns that I've shared with you are net of those fees. So that 2% is not taking out of the numbers I'm showing here. So that 10 to 12% on the Class A shares, or 11 to 14% of your compounding is net of the 2%. Do we write a restriction agreement to keep another lender from coming in later above you in the capital stack? Yeah, absolutely. So we have the ability we have to basically approve any additional capital coming into the fund. So, or not to the fund, into the deal itself. So the sponsors, operators cannot bring any new capital to the deal without our consent. How do you access the master class? We will send that out. If you click on the QR code or go to text that number, we'll send you the link to that. Is there leverage in the fund? Nope, there's no leverage right now in the fund. All these returns are without leverage. It's possible down the road we might add a little bit of deal level leverage, but that's not currently in the fund right now. If that's true, if that does happen, it's possible it might generate a little bit of UBIT, but again, it's not going to be very much. If you're concerned about UBIT, there's actually been some new rules with how UBIT is handled from a tax standpoint, and is pretty minimal of an impact, especially at the levels we would consider it would be less than 20-25%, at a very maximum at a portfolio level. So it'd be very minimal leverage, if any. At this point, we have no leverage, so there's no UBIT issues. We have a lot of IRA investors that have already invested in the fund, so it's a very popular, type of investment for that type of an investor. Is there any leverage used? I just answered that. Do you have opportunity to invest in the oil and gas drilling fund? Yeah, so we have oil and gas in their asset class we're doing. We potentially have a fund that will open later this year, but that's not open right now. Yeah, so this would be a single K1. So it's basically a consolidated K1. You're not going to have to file individual K1s in the individual states that the assets are in. That's at least what we've been told from the CPAs at this point. So you should not have to expect to file in any other states. All right. With that, thank you all so much. Great questions. Really appreciate you guys taking a little bit of your evening here with us. I'm going to put up that QR code on the screen again. So if you do want to talk with our team, want to get more information, just scan that code or text the word credit to 913-214-1474. And we can get you more information, send you the masterclass, send you our data room with all the asset level information and full presentation there. So with that, appreciate you all so much, and have a great evening.